Hey, it's Rob. Welcome to Everyday Investor, the hottest investment show in the world. That's right. I said it. I don't care who knows it. This show is all about helping all of us grow our money. You see, the challenge at times is we take our time, we go to work in order to get a paycheck so that we can eat. Let me say that again. We take our time, we go to work, we make money in order to provide. But imagine a world where money could make you money, where if you wanted to, you could work a little less and have more time for the things that matter most in life. Family, friends, engaging in a purpose greater than yourself. That is our goal with the Everyday Investor TV show. Remember, whenever you're introduced to any type of investment opportunity, you always want to ask 4 questions to start. Number 1, what's the return on investment? Number 2, when do I get that return along with the money that I put in? 3, what is the minimum amount needed? And 4, what is the risk? Super excited for you to hear about today's episode, the topic on today's episode. You want to know what it is? Stay tuned. We'll be right back. Coming up on Everyday Investor, we talk to D'Arcy McConvey and how we can make money investing in social living.
But effectively all co-living is it's rent by the room instead of rent a unit. So you'll have a key to your door, you'll have an ensuite bathroom, you'll have your bedroom, and then you'll share the sort of living space and the kitchen area with other people renting those units.
The mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage team today, Canada's mortgage choice.
Hey, it's Rob. Welcome back to Everyday Investor. Super excited to learn how we can make money investing in social living. Not sure what that is? Don't worry. My good friend D'Arcy McConvey will tell us all about it. But before we talk to D'Arcy, let's go see what's happening in the world of stocks with our stocks expert, Omar Khan. Omar, what's happening this week?
Thanks, Rob. Omar Khan here, guys, with Data Trading. Just want to give you guys a weekly market recap. We had mostly red arrows last week. This is coming after 4 consecutive positive weeks in the market. The S&P 500 was down 1.43%. The TSX was down about 0.74%. And the NASDAQ was off about 1.5%. So not the best week because of unknowns, right? So the U.S. Is transitioning to a new government this week. And the markets don't like uncertainty, especially the current political environment and all the uncertainty that's surrounding it. So shed a bit of ground. There was a very important measure this week, which is the $1.9 trillion stimulus package offered up by Joe Biden's incoming administration. Let's see how the market takes that the next little while. I think it'll be quite favorable, but let's see how the markets move going forward. A lot of important data to come out. And obviously, we're all hoping for the end of coronavirus sooner or later. Back to you, Rob, and we'll see you guys next week.
Thanks, Omar. Always great to hear your wisdom. D'Arcy, thank you so much for doing this with me.
Rav, I am ecstatic to be here. You know, we're not face-to-face, belly-to-belly in the same studio, but nevertheless, it's nice to see that face.
You're too kind. And if we were belly-to-belly, you'd be too far away from me. COVID has not been good to Rav. But I try. But listen, D'Arcy, it's, we work together at Greybrook Realty Partners, and you're doing a lot of work on the U.S. side of things. Of course, we're in land development projects. We're in apartment building projects. But now we've kind of fallen into something over the last couple of years, and that's, the social living aspect of things. Talk a little bit about what that is. Describe this kind of new vehicle of investment for the everyday investor.
Again, thanks for having me, Rob. Happy to explain to a lot of your viewers and listeners, as real estate evolves. So we at Greybrook, along with our partner in the U.S., a large development-based partner, Property Markets Group, otherwise known as PMG, have kind of, tied forces and have started a brand called Society Living. So you said social living, and society living is really, if you step back and you think about multifamily, so multifamily being, like traditional apartments, and Greybrook historically has invested in value add multifamily where you're buying older assets, renovating them, and sort of increasing the income. Well, on our society side, it's think about multifamily ground up development. So no different than sort of condo development in Toronto, where you're building from the ground up. In the US, what we're doing in the society brand is you build an apartment, new build apartment from the ground up. The difference being, you have some different considerations because instead of selling like condos unit by unit, you actually are building to rent. And one of the very interesting things in these buildings is that they're 2, 3, or 4 bedroom layouts for the most part, but up to 50% of a given building is actually co-living. So co-living is a pretty topical thing in real estate these days, whether it's in Europe, in the US, or now even coming into Canada a little bit. But effectively all co-living is it's rent by the room instead of rent a unit. So you'll have a key to your door, you'll have an ensuite bathroom, you'll have your bedroom, and then you'll share the sort of living space and the kitchen area with other people renting those units. So the concept around society is create buildings that create a sense of community for people, and a place that people want to live, work, and be proud of to live in. So what does that mean? It means very much tech enabled. So, the demographic that it's targeted to is predominantly millennials, but it stretches beyond that to, older, the older population as well, even young families. So it's very much tech enabled. You've got an app to scan in and out of your room. You've got an app to scan in and out of the building. Incredible gym facilities. You've got these co-working labs, which effectively are mini office spaces that you can rent, as well as tremendous and vast sort of event spaces. So it's really this concept of a place to live, but also a place to share into an experience, and to create a lifestyle that doesn't really exist in what we know as a traditional apartment building, right? And so it's the evolution of multifamily, I would say.
No, I love it. So we've branded it Society Living, Society. I call it social living just because obviously that's the purpose of it, that we can, interact with one another. And no, it's very exciting. I know a bunch of the guys went down there to look at the first few that Greybrook did in South Florida. Now we're looking at other parts of America, such as Denver. And so I heard you say that 50% of them, you rent out your bedroom. It's got an ensuite, a washroom, so you have your very own washroom. But then there's many where you can have your own little apartment as well, whether it's a 2-bedroom, 3-bedroom. But everybody shares all the common areas, such as I've heard there's, in some there could be, restaurants, yoga studios, as you said, kind of like the WeWork areas, swimming pool, all that kind of stuff. So I would think, D'Arcy, to be able to do that, you probably need a lot of space. Like something like that probably wouldn't work in Toronto, would it?
It's a little bit, yeah, it's a little bit trickier to do in certain markets. Like for instance, in one of our Miami projects, we have 70,000 square feet of amenity space, and so that amenity space becomes the space where you're effectively not renting it, right? Where it's the gyms, it's the event space, it's the pool. And in a place like Toronto, you'd get heartburn thinking about having 70,000 square feet of amenity space, and the rents that you would need to charge to be able to make sense out of this model, it would be significantly higher than maybe we'd feel comfortable underwriting to. So I think it works better in certain markets, no question about it. Like, but with similar characteristics to Toronto, really, where markets that are, for the most part, growing populations, but somewhat where the call it the millennials are somewhat priced out of ownership, where they want to live in core urban areas where there's a lot of opportunity, whether it's tech jobs or just jobs generally. You've got a great quality of life, including, restaurants, arts, and these types of things. But ownership can be prohibitively expensive. And so you create these society buildings to sort of create that pride of ownership, even though you're a renter, and you still have access to all the things that you need to access. And you actually have savings where, if you think about your internet costs, maybe your event costs, your gym and facility costs that you'd otherwise be spending to go to the nicest gym in town. Now you have all of that in your building. So it wouldn't work quite the same in Toronto, or maybe it would look a little different in a different form, but that is not necessarily our focus market for what we're doing in the US. Our focused markets historically have been South Florida. We're really interested in the Sun Belt, which is, the south, really the southeast, all the way across to, Arizona, including Texas and some other major markets where you have growing populations, you have, population migration. If you look at, a lot of the cities in Arizona, a lot of cities in Texas, some of the Carolinas, Nashville, Charleston, and particularly we've got a very deep interest in Denver, where we're going to be doing a Society Denver project, it looks like, next year. So, a lot of interesting trends to follow where people are moving to and from, and a lot of markets where this strategy, we believe, will work very well.
Like you said, we could build an apartment building and rent it out. This is a little different. Obviously, there's going to be a lot, and there is a lot of demand. I've heard a lot of people that have said, it saved my life being able to live in this during COVID because, I don't have to leave, but I can still kind of interact at a distance. What's the premium, D'Arcy, somebody may pay if it was a, 2-bedroom apartment in the same area as opposed to society?
One of the things that we're very conscious of is, like, at the end of the day, if you're renting, you can have all the bells and whistles in the world, but if it's way more expensive than the rest of the market, it becomes a super luxury product, and it's just not accessible for many people because a lot of people in these urban centers are spending a high percentage of their income already just to put a roof over their head. So having said all this, fun stuff about, what it's like and the lifestyle, the main concern is how do you make this product with everything it offers become competitive in the market and priced at market rate? Because if you can do that, now you can draw people who wouldn't want to live in the new building with all the cool stuff if it's priced the same on a total dollar basis per month. So if I'm paying $1,600 a month in building A, and building B is this new society building, and it's $1,600 as well, I'm taking building B all day. And so really what we've done is, if we've, in a lot of these markets, it's a little bit different. If most of your viewership is probably from sort of the greater, Ontario based, I'm guessing. We're very used to very small format condos in Toronto. Whereas in a lot of other major markets, the average 1-bedroom and 2-bedroom are much larger. And so, what we've done is we've taken that average unit size in the markets we're in, compressed them slightly, but you build efficiently so the space still feels as spacious. You have everything you need. You don't really notice that it's 100 square feet smaller. But your total dollars are the same. So from an investor perspective, the price per square foot, which is the metric that we're most concerned about, is greater than the market. So from an investment perspective, it's good. But for the actual tenant, it's the same total dollar outlay because we've compressed the average unit size and made it a smaller square footprint. And so really that's the way we've gone about it, and the way we're able to still generate, really good investment returns for our investors, but also make it affordable for the masses per se.
And so as Rav wants to invest in one of these projects, what's minimum amount needed to be able to do that? And are we in Canadian dollars, US dollars? Can I use registered funds, RSP, TFSA, all that kind of good stuff?
Yeah, sure. We can drill into I would say this, any listeners or viewers, can contact us anytime, and I'm sure, you can splash up our contact details. But aside from that is minimum investment in any given project is 25,000 in $100 increments above that. So, 25,000 up to millions of dollars, depending on who the investor might be. And so that's the minimum in any given project. Our projects are eligible for registered investments, yes. So RSPs, TFSAs traditionally. In the US, TFSAs no, but for most registered accounts, I don't want to go into too much detail there. And then your third question was what? What's the minimum? Are they registered, eligible?
Canadian funds or US funds?
So you can fund in either denomination, Canadian or US, in either currency, I should say. The projects themselves are US denominated because they're US based projects. And so you're paying trades and, buying supplies in US currency. But you can invest as a Canadian investor in Canadian or US currency.
Perfect. Listen, we're going to take a quick break. Time flies when we're having fun and being nurtured. Don't go anywhere. We're talking to my good friend D'Arcy, learning how we can grow our money investing in society, otherwise known for me as social living. Don't go anywhere. Everyday Investor continues in a moment.
The mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage team today, Canada's mortgage choice.
Hey, it's Rav. Welcome back to Everyday Investor. We are being nurtured by my good friend D'Arcy on how we can grow our money. Before we get back to it, we are going to find out what's happening in the world of mortgages with our mortgage expert, Kyle Ford. Kyle, what's happening?
Thanks, Rav. Today I want to talk about how many properties can a real estate investor own. Many people believe that there's a 5-property limit. This generally comes from banks' internal guidelines. It's not uncommon for a traditional Big 5 bank to have a 5-property residential cap, which means once you've bought your 5 properties, they don't want to lend residential mortgages to you. There still may be options in the commercial divisions or with another lender. As you're scaling past the 5-property thresholds, debt coverage ratio becomes even more important. Make sure that you're buying good properties in a good area that produce a high monthly cash flow. If these properties are debt servicing themselves and producing a positive income, it's going to make your portfolio more scalable and easier to bust through that elusive 5-property limit. Make sure you're working with a mortgage professional, and don't be afraid to ask questions about different options such as commercial, corporate structure, as well as commercial lending. Thanks, and back to you, Rav.
Thanks, Kyle. Always great to hear from you. Look forward to hearing from you next week. D'Arcy, thanks for being on the show and teaching us how we can make money. So one question I have is, as this is an income producing product, how does Rav, the investor, am I just making, cash flow passively every year? Is there an exit that Greybrook puts into place? How does that work?
By the way, I don't know that anyone's told me I've nurtured them before, so that's great.
I'm always, watch this here for a second. I am always in school with D'Arcy. That's what we're doing today, folks. In case you're wondering, viewers, we are in school with D'Arcy McConvey, of course.
Oh, man. Yeah, here we are. So your question. So basically, we have finite timelines in all of our investments. So it's not dissimilar to sort of, it's development. So, typically your investment goes in on day one. And now if there's a site that's, you have to demolish it and then build with the new building back up, that takes, years. Typically projects are anywhere from, call it 3 to 5 years, depending on the size and the scope and what's involved. But back you build it up, and then you tenant it, right? So you have a program where you're going to lease up the units. If you look at a project that we have currently in Fort Lauderdale, it's 800 plus units. So it's a massive building. By the way, if anyone wants to reference these projects in their Instagram, and if they're on Instagram, they can check out at Society Las Olas or at Society Wynwood or at Society Biscayne, and they can get a good feel for what the buildings are like. So back to Society Las Olas, we've given it, call it a year to lease up, about a year plus to lease up over 800 units, and then once the building is leased and what's called stabilized, then it starts producing an income stream. At which point, and typically it's not as binary as this, but we'll have these conversations ongoing. We know that there's sort of pension plans, insurance companies, or other big capital sources that want to buy these assets for income going forward. And so our plan from day one is build, stabilize, sell the asset to a buyer. And why these are attractive is if you look at multifamily. So again, we're calling it co-living, we're calling it society. It's got a lot of really interesting things that make it very attractive for people. But at the end of the day, it's multifamily. When you have a multifamily asset in a core market that's new built, in some cases on the ocean or close to the water, like these are the most sought after assets for the most part in all of real estate, and they command sort of top prices. So, there's a number of buyers that seek this type of asset, and so we feel like if you deliver it at the right price and well, it can be a very, very good investment.
So, D'Arcy, so these are typically 4 to 6 years then?
Yeah, 4 to 6 years.
4 to 6 years. And you said minimum $25K. We can put in cash, registered funds. You can invest Canadian as well as USDs.
Mm-hmm.
Now, typically when we do land development, when we're building manufacturing housing, when we're building or adding value to apartment buildings and getting out, typically, we're 15 to 20% kind of projected returns annualized. Is it kind of the same thing?
Yeah, very similar return profile. So, not going into too much detail, I would say that, this is considered an alternative investment, kind of a private equity type investment. So investors are going to expect returns that are maybe higher than what they would expect in, your traditional equity markets or markets. And reason being is that, one, development takes time and your funds are locked up for a period of time. So your funds are locked up for 3 to 5 years. You're not seeing any income, and it's a profit sharing model. So people need to be compensated for that lockup period. That's one. And then two, in development, there's some risks associated that wouldn't be associated with other types of investment. Granted, our partners have outstanding track records, and we lean on that heavily, as do we. So people are compensated for this type of investment differently than they would be sort of a something that you could buy on the TSX or something like that.
Yeah, I mean, you and I both work with Greybrook, but we're also aggressively investing with Greybrook product, and obviously knowledge mitigates risk, and because again, you have a lot of knowledge and you pass it to me, it's what allows us to invest in what's called alternative investments. But yeah, with PMG, did they kind of come up with this concept? Is there other kind of people doing it?
It's if you look at this bucket of co-living, like there's a lot of versions of it, right? There's very simple boxes in the air and you're sharing, communal type living, all the way to this side of the spectrum, which is like we talked about, more bells and whistles. I call it, Las Vegas meets the dorms, where you've got, all the Wynn and all the stuff that comes with the Wynn casino, the casino, meets the dorm rooms. It's more than that, so I don't mean to make light of it. It's actually more than that. But so I wouldn't say PMJ came up with it, but I think, one of the interesting things about PMG is they've been developers for 30 plus years. And so they've built high rise all over the US, particularly New York, Chicago, Miami, or South Florida. And so it's one thing as you hear this sort of coin phrase being co-living, people are converting old hotels to co-living, and you hear it all the time. It's one thing to do that. It's another thing to highly amenitize, program, create a brand and a feeling, and develop that from the ground up. And PMG are developers at their core. They say development through and through. So I think that they have a very distinct advantage versus a lot of the other quote unquote sort of co-living builders or co-living brands out there, because they're coming from the ground up with the ability to think through all facets before the building is constructed. So they didn't invent the wheel. They're just kind of reinventing it, I would say, as they go.
Love it. So we covered, basically projected kind of returns for any of the Greybrook products, really. Our timeline, minimum amount that we can put in. And then we always ask, D'Arcy, what's the risk? What's the risk in something like this? Obviously, vacancy is risk, but how do we, so number one, is there any other risk other than vacancy? And number two, how do we, Greybrook, PMG, how do we mitigate that? Obviously, it's probably where we're looking, and but yeah, talk to that point for a second.
So if I was a lawyer, they'd write out a ton of risks, and for any of our investors that have invested in all the disclosure documents, there's all sorts of stuff disclosed. But I think one of the biggest risks is this idea of illiquidity. So your funds are locked up for a period of time, and we're going to project a timeline of 3, 4, 5, 6 years. But the reality is things can happen. A pandemic can hit. Things that you never would expect to happen would happen. And so, these things can ultimately, elongate a timeline, and which means your funds would be locked up for a longer period of time that you can't access them. So I think there's a number of risks. Of course, we do our best and have done our best to mitigate risks. But I think timeline and timeline extension and development is going to be your biggest risk. So you need to be comfortable that if you're investing in a 5-year project, to say, hey, this could turn into a 7-year project. If it does, am I still comfortable investing? And if the answer is yes, then it's probably a suitable investment, or there's other factors that would go into that determination. But I'd say timeline is a very big risk factor in development, and so people should be conscious of that.
Okay, great. And then I wrote vacancy here because that's with anything, but that's why we really vet where we are and see where there's demand for tenancy. And so you're not too worried about that. What I hear you saying is anything can happen. The return, we project it to be 5 years, might be 6 years, 7 years. And so the project still gets completed, but maybe our return is a little less than we thought. Or I've even seen it where it goes longer, but your return is higher for whatever reason. So,
it could be a combination of that. And look, vacancy can play into timeline. We've got we've got 800 units in Fort Lauderdale. It could take more time than we thought to lease them up. Granted, knock on wood, it's been going really well. Construction could take a little bit longer than you thought for whatever reason, or like we said, a pandemic in it. So a number of things can play into that timeline.
Perfect. D'Arcy, listen, love having you on the show. Time flies when we're having fun, when we're being nurtured. Thank you so much for doing this.
Yeah, no, thanks for having me. It's great, Rob, and stay well.
All right, you too. And thank you, viewers at home, or those of you that are listening via podcast. Without you, we would not have a show. Until next week, same time, same place. Honey, I love you. I'll be home soon. Bye, everyone.